Today, I'm going to show you guys the main types of things you can invest in the stock market, and also give you the benefits and drawbacks of each. What's up guys, Andrew Ferguson here from the Inconomist on a mission to help you guys learn how to invest and create wealth through real estate and stock investing. If that sounds like your kind of thing, subscribe to the channel, follow along, but let's get into today's video content and the first product that you can invest in the stock market. So just before we talk about stocks, this is your first time here at the channel, thank you for tuning in. The rest of the videos in the Stock Investing for Beginners series can be found by clicking the title card right there. If you want to go back and check things out, see how we got to this part today, go ahead and do that, but let's jump into stocks right now. So the easiest and most basic product out there is what's known as stock or company shares. What happens here is you are looking to buy shares of a company that you believe in long term at a price, wait for it to increase in value, and then sell it for a profit. It's the most basic thing that people do when they make money in the stock market, and it's the easiest for first timers to understand. The key here is to pick good companies with a track record of success and ones that you believe in long term. Buy their shares, hold them for a while, sell them to maximize your profits. So to get started with stocks, most people just target companies they know and like and just start buying shares there. So let me know in the comments below which companies you guys think would be good to buy shares in, or which ones you're targeting for your own portfolio. And let's move on to something a little bit more advanced. So next up, we're talking about exchange traded funds, or ETFs. I know it's a mouthful, but they break down like this. What they are is a melting pot. So there's a whole bunch of different stuff thrown into them, and it could be stocks, bonds, commodities, all packaged together into one product. And then you can buy and sell actual pieces of an ETF or shares of an ETF. And then you have a little bit more diversification, a little bit more broader investing in the market. And the only downside with that is there is a little bit of a management fee to do this. Whereas when you're buying and selling stocks yourself, it is very small, limited commissions. There's a little bit of an extra charge to have these ETFs in your portfolio, but it's minimal compared to other products out there. So it's also a good place to start for new investors, just to get a little bit more diversity in your portfolio and just take down that risk profile a little bit more versus investing in single shares of a company. So next up, we're talking about mutual funds. And although it's pretty close to ETFs, there's a couple differences that you should know. Instead of having a melting pot of product, it is considered a melting pot of money. So mutual funds means mutual people are pooling all their funds together. So this investor, a couple other ones put their money together into a pot. That pot is then invested by a money manager or a fund manager, and then everybody else that's invested in that actual mutual fund gets to reap the rewards of any profit made. Downside to these, they are expensive compared to ETFs and stocks with the management expenses that you have to pay. So if you don't want those to eat into your profits, if you want to do things on your own and limit those commissions that you're paying, you want to track into stocks and ETFs and leave mutual funds on the side. With that being said, if you don't have time to get educated and do that, mutual funds are a good option because someone who is in the know and manages money does have control of your portfolio. Just be prepared to pay an expense ratio if your account does well, and if your account does poorly. Either way, they're going to get their money. They are a pay-to-play product. So switching gears, we're going to index funds now, and index funds are these general broad market index funds that mimic the movement of the market. Things like the S&P 500, or that's known as the SPY, the SPY index. They mimic the top companies in the stock market and move in sync with how they do. It's more of a broad collection of companies, though. It's not investing in one or two companies. Again, it's spreading out that risk and diversifying across a whole bunch. They are similar to ETFs, but they track the performance. They don't actually have individual companies inside them. So they're a little bit different in that sense, but institutional investors like Warren Buffett really go to bat for index funds and think it's a great way to spread out your risk over time. The one drawback being that if you do have some growth stocks or shares of stocks on the side in actual single companies, and they do take off and explode, you're going to miss that growth in an index fund because they're not going to be able to mimic the growth of that one company where it's broad and it's mimicking the growth of a bunch of companies altogether. So you do miss out on potential growth, but over time, index funds have performed very well, and it's a good way to, again, spread out some risk and limit the upside, but also limit the risk going into your positions as well. The last actively traded product that I like to just let you guys know about is what's called bonds. And what bonds are, they're basically IOUs, or you're buying someone else's debt, usually a bank or government. And what bonds are good for is they have a finite expiration date and a finite rate of return. With that being said, because those things are locked in for a given amount of time, the returns are often very minimal. The bonds are thought of to be very safe investments because the risk is defined up front before you go and invest in them. You might get a bond that says it'll pay you 1% over 10 years. So you would invest $100. After 10 years, you would get $101 back. So it's just an example, but usually the bond rates are very, very minimal. You have to invest a lot of money into them, but they are guaranteed for that period of time. So that's why people like to kind of switch over to bonds a little bit more as they get into retirement age, just because it's a little bit more safe and the risk is defined up front before you make your investment. So those are the main 5 that you're going to see most people invest in. And there are some alternatives, which I'll get to in a second. But if you guys have gotten value so far, please smash that like button for me. Help me grow this channel. Help me bring the message I'm trying to get out to as many people as possible. That would be so muchly appreciated. And let's talk about those alternative investments that you can make. So the biggest alternative investment right now is what's known as cryptocurrency. And this is things like Bitcoin, which you maybe heard of. Ethereum is another big one, Litecoin. There's so many different coins you can get. They are decentralized, which means they're not part of the government money system. So it's kind of a different form of money. And if you Google it, do a quick search, there's tons of material out there on cryptocurrencies. Just go educate yourself if you want to get into that. And it is an option out there that you can invest in. Another one that you can do is what's known as commodities. And these are things like gold, silver, copper, timber, oil. All these different things are traded on the stock market as well. You can invest into like funds for them, ETFs for them, but you can also go and buy an actual collection of gold or silver and have a physical product as well. Gold is thought to be a good hedge against inflation, and it holds its value relatively well over time, but it is kind of pricey to get large quantities of, and there's a high barrier of entry. If you want to get little pieces to get started, that's great too, but you can invest in all these different commodities that aren't actually in the stock market. They're physical products that you can buy and hold, and they hold their value quite well. So I hope you guys enjoyed this video. There's a whole bunch of things that you guys can invest in, literally anything for any kind of investor. My advice to you would be to start small, start with one type of investment, and then scale it from there when you feel comfortable. But if you guys want to know more, keep checking out this series. This was part 3 of 6. If you guys subscribe and click the notification bell, you guys will be notified when the next video comes out. That way you won't miss it and we keep this party going. Next video is going to be all about how to get started and actually set up an account and how to fund your account and then how to size your portfolio properly to get you going. But again, thank you guys for checking out the video today. Keep investing in yourselves, and I will see you on the next one.